Hey, welcome everybody. We are going live here today on Mortgage Talk. It's my weekly little show on mortgage financing, and I'm excited to be back with everybody. I was out of town last week up in Detroit, actually Pontiac, Michigan. I've never been to Michigan before. It's kind of fun. I was up there on business. So I want to give a shout out to my marketing director, Leanna Borsellino, and my good friend, Kate Balderas, who held down the fort last week. And I hope it was worth everybody's while to watch that show or listen to that show, because her quarterly bonus is going to be dependent on that. Just kidding. So today I'm going to do sort of a Q&A. I've reached out to a lot of prospects and some realtors and say, hey, what are you hearing from your potential buyers in this market? What kind of questions are you getting from them? And I wrote down a whole bunch of them. I kind of wanted to talk about these questions a little more in detail to hopefully, get people in a better position mentally or psychologically or even financially to buy a property. So the first one is obviously very important. It says, how do rising interest rates affect my ability to get a mortgage? And obviously that's a very important question. It's a very good question. It's probably on top of everybody's mind who's on the sideline, whether you're a renter and you're thinking about buying your first home, or you're relocating to Austin area, or you're thinking about moving up or moving down and you have a property to sell. What are interest rates? How do they affect my ability to get a loan? And obviously it doesn't help. That's a challenge in this market for sure, because we've gone from around 2.5% about a year and a half ago to upwards to 7% now. So the math, the formula is along the lines. This is an average, but on average, every percent higher of interest rate decreases one's ability to buy by about 10% of the market. So in other words, let's say that you qualify for $500,000 on a mortgage at 6%. If it goes to 7%, 1% higher, your buying power goes down to around $450, about 10% less to keep the payment the same. That's a rule of thumb. And vice versa. If you buy a property today or thinking about property today at 7%, and if rates were to fall to 6%, your buying power would go up 10% to keep the same payment. So that's a very good rule of thumb you may want to use. And of course, that's aside from any taxes or insurance that'll be charged on a mortgage. I'm just talking about the mortgage itself, about 10% per rate of gain by the loan rate. The next question is, should I be concerned about the impact of inflation if I'm thinking about buying a house? Obviously, inflation has ticked up a lot. The problem was, and this is confusing, but inflation is a product or a result of the Federal Reserve pumping lots of money into the economy, which happened during COVID. There was some number like around $5 trillion that the Federal Reserve put into the banking system. So money was easy to get to, and rates had fallen quite a bit. That's changed in the last year and a half. The Fed has raised rates considerably since the last year and a half, maybe 2 years now. They're a little late to the game. So we saw a very sudden increase in inflation, and the Federal Reserve raising rates, trying to catch up with that. So inflation as a hedge, a lot of times real estate is considered a hedge against inflation because the cost of materials go up. So building a house will go up based on the cost of lumber and labor and all sorts of factors. So a lot of times buying a property or owning property is a hedge against inflation, just like maybe gold or silver made. Hard assets are usually considered a good hedge against inflation. So I don't think it's a problem buying in this market personally around that question. Now, time will tell what's going to happen there. But inflation starts to lower and come down, which is starting to show signs of that, then interest rates should also fall too, which is also going to increase the value of your property because more people can be in that market to buy it. So again, I think we've bottomed out right now in this, at least in the local Austin, Texas, Central Texas market, and I think it's still a good time to be buying. So what steps, here's the third question, what steps can I take to secure a competitive interest rate? Or in other words, how do I get the best deal? That's the bottom line. When rates were, I've been doing this since 85, when rates were at 13.5%. So I've seen rates fluctuate from 13.5% down to 2.5% over the last 37 years, up and down. And when rates were at the bottom a couple of years ago, probably 2021 and 2 years ago, people weren't complaining between a 2.5% rate and a 3% rate. There wasn't a whole lot of negotiation, if you will, between the banks and the brokers and the clients, because they thought it's all good. Now, if rates have moved higher, people are much more interested in getting the best deal, which I want to share with you another idea for you. If you're really interested in learning how to shop for a mortgage, reach out to me. My phone number is 512-789-6967, either but via text or call or email, mark@markhairston.com. And I'll be happy to share with you a consumer guide I wrote years ago, not in the last year or two, but I mean 5 or 6 years ago, on how to shop for the best deal. It's called The Truth in Lending. It's a 15-page white paper consumer guide, how I kind of pull back the curtains against in the mortgage industry and tell you how it works. So you can make educated conversation, whether be a broker like me or your bank or credit union or mortgage lender or online lenders, whoever you speak with. It'll give you some detailed information on how to make sure that you put yourself in the best position, if you will, to win, because there's a big difference between 6.5% and 7% on an interest rate in this market with these prices. Okay, so is it a good time to buy a home in the uncertain economy? That's a question you're going to have to answer for yourself, because I can't tell you what to do, or I don't want to tell you what to do. I can barely tell myself what to do. That's done. But I bought my first home in 1990 in Austin, Texas, and we were in a bad recession. This is the fourth, I hate to call it a recession per se, but it's certainly the fourth correction we've had in the real estate market since I've been in the business. We had one in the late 80s, mid to late 80s for sure, around 2000, 2001. The big one was 08 to 010 to 2010, and this fourth one is in the last year or so. And I find this one to be more interesting than the others. But anyway, my first home I bought in 1990. I bought a property down in Oak Hill area off of William Cannon and Escarpment, if you know the area, Village of Western Oaks area. And it is a bad economy. We were coming out of a really bad economy. The point around that is always, and I've said this before on this show, and I've said it in private conversations, you make your money on the buy and not when you sell. In other words, if you can buy at the right time, that's where you're going to make your profit. And I think today, because the price is coming down the last year, 14, 15 months, that this is an excellent time to buy, because I think that interest rates will be coming down next year. I don't know how much, but I don't see them going much higher than this. And as interest rates fall, I think you'll make a good investment if you can afford the property at these rates. And that's the kicker right now. We're going to talk about that a little bit more as we go. So buying in a recession, or maybe coming out of a recession, is a great time. My last home, well, not the last home I bought, but I bought another property in 2010, my wife and I did. And we bought a property in the Lost Creek area. And if you remember, 2010 was some of the worst economy we've ever seen. I mean, the banking system, the whole economy almost fell. But we weren't worried about that. We thought it was a great time to buy then, and it was. It turned out to be a great investment. We still own that property, and we lease it out for a profit. And so typically speaking, you want to buy at the low, whether it be stocks or any investment. You want to make sure you buy at the low, and I think we're very close to the low, if not at the bottom. So how does an uncertain economy impact the housing market? Well, we've seen that in the last 15 months that prices have come down. So that's how an uncertain market is going to affect the economy. There's a lot more to it than just that. You know, it's about jobs. You know, and Texas is a very fortunate state in the sense that a lot of jobs are still moving here. I think I heard Governor Abbott say that about 25 large corporations have relocated in the Dallas-Fort Worth area, not to mention, you know, Central Texas in general. So Texas is still a very favorable business market. And that's the key. Employment's always the key to a healthy real estate market. Because without that, you know, like I mentioned, I was in Detroit this past week. Between Detroit and Pontiac, Michigan. Now, Detroit downtown is a beautiful city. I went to see the Tigers and Reds play, had a great time at the game. Took an Uber down there from Pontiac. Michigan's a beautiful state. But just driving in the Uber for about 40 minutes or so, you could see along the road lots of vacant properties, just basically boarded up all along the freeways. And that's not going into more of the inner city. So Detroit's lost a lot of jobs over the years, population over the years, and some of that real estate's just sitting there. Maybe a good time to buy in Detroit. I don't know. But Texas, on the other hand, has been a migration center for businesses. Tesla's obviously came here, and Oracle and Samsung's building that huge plant. And it's not just those big names. You hear about the big names, but it's all the supplemental businesses and industries that come to support those big companies. So again, I feel I've been in Austin for 46 years now, and I'm not really going anywhere. I still think it's a great place to live. I'm pro real estate. I'm bullish on Austin and real estate. So I would not be personally too concerned about buying property in this market. We're looking for some other property right now. Are there any government programs or incentives available? One of the things that's different, and I was talking to a mortgage friend of mine yesterday, and we were saying this is in some ways worse in my industry. I'm not saying in general, but my industry than it was in 2008, 2009, 2010, because the government stepped in with a lot of incentives for people to buy. And they were talking about down payment programs and tax incentives and things like that for first-time buyers. First-time buyers drive the market, generally speaking, because if you buy first-time buyers buy a property, then that seller can do something different. They can move up or move out or whatever. So a lot of times first-time buyers are key, which we're starting to see a lot of that come back in this market now. About half our business, I would say at least half, maybe more, is first-time buyers, people who are living in apartments or coming out of college or have a roommate, and they want to say, hey, I'm done with this. I don't want to live in this rental property. I want to go buy my own place. Because there's an old saying, you're going to pay a mortgage, you might as well pay your own because you're paying somebody's. That's for sure. But in this economy, the government really hasn't done much. And I'm not saying they should. I'm just saying they haven't done much as far as incentives to be able to buy. Now, we're going to talk in a minute about a program called MCC, which I think is very, very important that a lot of lenders don't either know or they don't talk about. I'll just talk about it now. MCC stands for Mortgage Credit Certificate. It's nothing new. MCC is a government program, national. It's not for Texas. It's not for my company. It's for anybody that qualifies. And you qualify as a first-time buyer. First-time buyer is somebody who's either never owned a property or hasn't owned a homestead in 3 years. That would be considered a first-time buyer. And the government says, look, if you're a first-time buyer, this is a great incentive. We'll offer you up to $2,000 tax credit if you buy a home. And every year you live in this home, we'll give you a $2,000 tax credit. Tax credit is different than a tax deduction. You can deduct your interest and taxes against your taxable income. But a tax credit is such that it's a dollar for dollar deduction from what you owe. So at the end of the year, let's say in April, you file your taxes and you owe $2,000. If you have this program, it can only be done in the loan process. It can't be done after you close. So make sure your lender is talking to you about this program if in fact you qualify. But let's say in April you owe $2,000. Well, if you have this, you don't owe any money. Or let's say you're going to get back $1,000. And if you have the MCC program in place every year, not just the first year, but every year, in this case, you'll get $3,000 back if you get $1,000 back from the government. So that's not a new program. That's been around since really the mid to early 90s, as I recall. So it's not new, but that's the only incentive I can really think about off the top of my head that would encourage people to look at buying as a first-time buyer. What are the current rates and how do they compare historically? Well, as I mentioned, the answer to the question really the current rates are on a fixed rate or around 7%. Fixed 30-year. Now I've just locked a loan in yesterday for a client who's refinancing into a 15-year. He bought a property in May of this year, and he borrowed around $725. He had a home that he was going to sell, but he qualified with his current mortgage, so he didn't need to sell the property first to buy. But he knew he was going to be selling that property, and he did. Matter of fact, he's closing today. And he's going to receive about $400,000 in equity. He's going to put that down on on the property we financed in the loan. So he's going to be borrowing around $325,000 on a 15-year note, and I locked him at 6.25%. And so he's very happy with that because his payment's going to be a little bit less than he's paying now to go to a 15-year note. So The answer, but fixed rates, normally people go to a 30-year loan because it keeps your payment relatively as low as you can. Now, when I got in the business in 85, like I mentioned, rates were 13.5%, and they've fallen over the years anywhere from 13.5 to 2.5. But on average, rates historically, 40-year average has been around 6%. So we're a little higher than the national average historically. But I do believe we'll see those rates come down in that market, hopefully in the fives in the next year or so, depending on a lot of factors. So that would be a comparison of where we are today versus history. Another question is how can I improve my credit score, and how does that help me? Well, a few months ago, about a month ago, I guess, we had a 3-week series on credit scoring, how to increase your scores, and it helps quite a bit. The higher your score, the better deal you're going to get. Now, that's in the conventional market. If you're a veteran or if you're in the FHA market, it's not as significant. It's not as big a deal as your credit score is from, let's say, 650 to 750. But on a conventional loan, it is. And most of our business right now is conventional financing. But I would suggest that one of the keys, well, there's several keys, but one of them is to make your payments on time, number one. Obviously, always make your payments on time, even if it's just the minimum. So if it's $25 minimum payment and you owe $1,000, just make the $25. At least do that. But the other key is to keep your balances as low as possible. Now, the problem that we're seeing today, when I talk to clients, is their credit card balances are much higher. Matter of fact, we have reached a record in this country of credit card debt. It's over $1 trillion. Now, we've never seen that before, but what we call unsecured debt, credit card unsecured debt, over $1 trillion. 2 years ago, because of all the free money that people got, not only were savings rates higher, but credit card balances were around $600 billion. And this goes 2 or 3 years ago. So it's not quite doubled, but it's gone up significantly in the last, certainly in the last year. Because I wouldn't say people are living on credit cards, but they're certainly using them more so than ever. And I'm guilty of it too. I've got some credit card debt I need to get handled between you and me. So number one is to make your payments on time. Number two is to reduce your credit card balances or your total debt as much as you possibly can, and I'm working on that myself. So what is the maximum? And again, the higher your credit score is in the conventional market, the better your deal. So if you save an eighth or a quarter on an interest rate and you're borrowing $500,000, $600,000, that over time, that adds up quite a bit. So it's going to save you ultimately thousands of dollars. What is the maximum mortgage amount? Now, this is a question I get practically every day because people say, hey, I want to know how much I can borrow. Okay. And until we get to the weeds with people about income and credit and down payment and whatnot, a good rule of thumb is we're going to take 50%. This is a rule of thumb. It's not an exact science, but keep it in mind if you want to do some quick calculations. We take 50% of your gross income. So let's say a married couple makes $10,000 a month gross income before taxes, before 401k, before health care expenses, anything like that. Whatever you make as a gross income, we take 50% of that. So let's say that number would be $5,000. Then we back out any debt you may have. Let's say student loans, car loans, revolving credit loans, personal loans, things like that. And let's assume for a minute that's $1,500. We take that out of the $5,000. We leave you $3,500. The $3,500 is how much we would allow you for a mortgage payment. So, and that would include taxes, insurance, and homeowners insurance, and all those sorts of mortgage insurance, whatever. The $3,500 would have to cover all of that, whatever's left over after you deduct the expenses. And a $3,500 payment in today's market with these rates and taxes is probably around a $4.25 to $450,000 loan. Of course, that's after your down payment. So let's say you bought a property for $500,000, or let's say $500,000. Put down 10%, and you're borrowing $450,000. Your payment should be in the $3,500 range, depending on other factors. So that's just a rule of thumb. But be sure you consult with a mortgage consultant, make sure you consult with somebody who can give these details. That reminds me of a couple who were coming out of California, and they got pre-approved, but all I could approve them for was $275,000. But they wanted to buy a house for $375,000. So I said, well, I may not be the right source for you. And I did all I could for them, but I couldn't get them that much money. So I talked to the agent this past week. I said, hey, did they ever close? He said, yeah, they did. And he said they actually got denied. But she went out. The wife was not working. The husband was being transferred here with Home Depot, but the wife was not working at the time. And he said, yeah, they made her go get a job so they could borrow, the other $100,000. And I guess maybe I should have thought about that, but she told me she didn't want to work. So anyway, because they got pre-approved by this lender. Well, they didn't get pre-approved. They got denied until she went to got a job. So always sort of many ways to skin a cat. Okay, what are closing costs? Great question, because there's lots of closing costs. Now, closing costs are third-party fees, and people think if they put down, a lot of people think if they put down 10%, maybe they don't have other costs per se, but there's going to be several $1,000s worth of closing costs. And they're third-party fees like the lender fees. My fee as a mortgage broker, the borrower doesn't pay me. I get paid by the lender, whoever I sell that loan to. But the lenders have charges. There's appraisal fees, there's attorney fees, there's title costs, there's surveys, there's recording fees, there's all sorts of third-party fees. And on average they run about $4,500 to $5,000. That's just the closing fees. Now the question was, can they be negotiated? And we're seeing most of the time, and I would say 3 out of 4 loans these days, the seller is participating in paying some of those fees. They're negotiable. So on a conventional loan with 5% down, the seller can pay up to 3% of the sales price for closing costs. So a $500,000 property, that'd be 3%, would be $15,000. The closing costs don't run $15,000. So that's if you want to buy points to buy down the rate possibly. On FHA, it's going to be around 6%. So again, there's a lot of latitude on FHA for the seller to pay a lot of the fees as far as buy down costs. There's ways of reducing your costs or your rates temporarily. It's called a 2-1 or 3-1 buy down, 3-2-1 buy down. And that's probably for another day. We could talk about that. But that's also a tool of negotiation that we're starting to see a lot with buyers because they can't afford a 7% rate. But 2-1 buy down affords them the opportunity to get a 5% rate in the first year, 6% in the second year, and 7% the third on. So that cost, there's fees to lower that rate temporarily. That's going to be paid by the seller too. So again, most of the time, because of the market in general, we're not really in a bad market. We're in what I call a balanced market. On average, properties are selling between 3 and 4 months on the market. 2 years ago, there was 3 or 4 days, literally, or certainly 3 or 4 weeks before a property would sell. Those days are kind of over. We're sort of back to a normal market where there's more negotiation between a buyer and seller. And there we're seeing a lot of people come to the market that maybe couldn't buy 2 years ago. So I think it's a healthy thing. It's a healthy thing all around. This COVID thing was a weird time, but those days are at least over for now. They keep talking about masks coming back, but we'll talk about that some other time. So how long does a mortgage approval take? Well, that's a great question. On average, we can usually close a loan within 3 weeks. We say a month, but we really don't need a month anymore. The technology around mortgage financing is such that, we could process these loans and close them usually between 2 and 3 weeks. When I got in the business in the 80s, there was no internet, there was no technology, there was no Facebook, if you will. And they would take sometimes 6 to 7 weeks, but that was when everything was piled in a package like this of paper. We don't really do paper anymore. Everything's done pretty much electronically. And so on average, we can close pretty quickly. And that's an incentive for people, because if you get pre-approved, let's say with me or anybody for that matter, and you get pre-approved, you get all your ducks in a row, as they say, and you contract, we can usually close in 2 weeks. So that may make the difference between getting that property or not getting it. If you come in prepared, and that's one of the questions they keep asking, what's the benefit of getting pre-approved? Well, the benefit is your negotiations your negotiation goes way up in your favor, because the seller is saying, hey, this guy's been through the process. And as a lender, I'll usually call the listing agent and say, yeah, this couple or this client is well qualified. We've got them all prepared as far as their payment. They're very comfortable with their payment and their interest rates and all that sort of thing. We write a letter to that effect. And that's something you really want to work with, because I had a client call me last week and he wasn't pre-approved, but he wanted to buy a property and he lost on that deal because he didn't have time. He didn't have his ducks in a row. So he lost on that property. Now he's in position because we've done everything up front. The next property, I'm sure he's going to get. Okay, so what about tax incentives? And this is a good question too. The government's always, and I mean always, had some incentives for people to buy property, real estate in general, whether it be commercial property or residential property. And so there are tax incentives available to you. And let me know. I've got to wrap this thing up, but call me and we'll talk about your specific situation, because I want to make sure you're clear about everything we're talking about today and a lot of other questions I didn't have time to cover. So again, Mark Hairston, Mortgage Talk. I appreciate you guys being with us. See you next week. Bye-bye. That was money.
That was money.
How do I stop this? Oh,
Push